Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis and investment insights that'll boost your trading potential. Coming up, we got U.S. markets looking for direction. Broadcom is weighing on technology shares. Investors are also assessing falling oil prices and ongoing developments in the Middle East. Plus, with SpaceX expected to make its market debut next week, we'll speak with Renaissance Capital's Avery Marquez about whether the market can absorb a new wave of mega-IPOs, including SpaceX, OpenAI and Anthropic, and also what investors should watch for beyond the first days of trading. And later, we break down the bull and bear case for IonQ as quantum computing captures more investor attention. We'll also look at option strategies traders can use to position for both sides of the trade. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. We are half an hour into the trading. Let's check in on the market. We'll start with the S&P 500. The Dow is actually up about 700 points. The healthcare names are moving. The S&P 500 is down modestly, while the Nasdaq is down even more. It's a bit of a tech story right now. So I just gave you the laydown between the big three. They're not behaving the same. Let's jump into the heat map on the S&P 100 to see where some of the trouble might be. Not only for the S&P 500, but for the Nasdaq as well. It is Broadcom right there, AVGO, down about 15%. And Micron also in sympathy, a lot of the chip makers. So what is going on here? Let's break it down. This is actually Broadcom news. It's being all led lower by that name. It designs, of course, makes customized AI chips for other technology names. Well, they came out with weaker than expected earnings after the close yesterday. The forecast is also troubling the street and, of course, leads to questions about the AI trade. Big drop off at the open, and it just seems to be moving lower at this hour, and it is weighing on the S&P 500 and the Nasdaq. And that is your market update. Joining me now is my colleague Hiran Amin from our direct investing educational team and Avery Marquez, Director of Investment Strategies at Renaissance Capital. Thanks, both of you, for being here with us. Before we jump into the conversation, just want to remind our viewers that the views and forecasts expressed are solely those of Avery and her team at Renaissance Capital and based on their research. Avery, the IPO market showing signs of life again. Of course, the market's very interested. Some are very excited about SpaceX. Tell me how important that this debut could be for the overall markets and for what's to come.
It is a little bit difficult to say how much of this is going to be a bellwether for the broader market. It's definitely got a lot of eyes on it, and it'll be a catalyst in the sense that a lot of deals are trying to maybe get out beforehand, and we'll be watching it very closely to see if they want to commit to a summer listing. But as far as broader activity, this is kind of a very unique offering, both at the deal level and maybe at the story level. But it is a large, high-profile, disruptive technology company. So it's going to be a good test of appetite and probably capacity as well.
All right, a test of appetite and capacity in the sense of that first day of trading. Is it important then for that appetite, for that capacity for the markets, for that day to go well? I think if we go way, way back to maybe Facebook, things didn't go so well on the first day.
Yeah, the first day will tell us a lot, especially about the demand dynamics in the actual trading. That's really where the rubber meets the road for new stocks. So we expect it to have pretty volatile early trading, as very hot deals often do, and a very strong first day showing could tell other issuers that there is that first day demand. What's going to be really important is watching the trading after that. The aftermarket is really going to tell us where the demand goes from there. Is this something that just flips hands really early on, or does it have sustainable interest?
Morningstar dropped a pretty striking note earlier this week. They said SpaceX is worth $780 billion. That's roughly half the 1.77 trillion that it's targeting at 135 a share. That's a bull call when the roadshow hasn't even started. What's the biggest misunderstanding that investors are carrying into this one?
I think the biggest misunderstanding here is maybe how much of the hype or the FOMO is kind of being baked into this valuation. I think the Morningstar report is definitely eye-opening, but maybe what it's also not considering is just the mishmash of companies that makes up the modern day SpaceX. You're really not saying that, rockets and rocket launches is worth 1.75 trillion. You're saying that three distinct lines of businesses, three distinct businesses are baking in to make this very large valuation. Is it appropriate? I guess we'll see in trading what public investors think.
And that begs to ask the question, because the valuation question cuts right into this. SpaceX is reportedly posting net losses, I think over $4 billion in the last quarter alone, yet it's priced at 67 times sales, 3 times more than NVIDIA's multiple, just for context. So honestly, how much of this demand is fundamentals driven and how much of it is just the Musk effect? Where does one end and the other begin?
Yeah, definitely hard to say with SpaceX. Yeah, the fundamentals are challenging and they're a little bit hairy. The growth is pretty uneven, and if the expectations, if expectations of growth are the foundation of evaluation, like I think it is with SpaceX, particularly the Starship line of business, and maybe even like the AI component, the AI compute, post IPO execution is going to be key. So right now, is it the fundamentals? Is it Musk? I think it's going to really depend.
Avery, a couple of weeks ago, I was talking to one of my colleagues at TD Epic, Kevin Hebner, and he said something very interesting to me in the sense that, Hiram was asking about the fundamentals is very tough. He called buying into this almost like a call option on Mars colonies, on robots. And so when we start trying to find out, like a traditional IPO, maybe we look at the metrics that are included in the filings. We say, okay, they're making this much and they're pre-revenue this or pre-profit that. Where do we even hang our hat on this one?
Yeah, a colleague of mine actually had said something similar, that this is essentially like a bet on a 20, 30-year growth story. This is not your typical clear-cut DCF where you're valuing a company that has 10 years of sales. I mean, SpaceX does have 20 years of history, but the actual basis of their story is this kind of moonshot vision of going to Mars, of the starships, of these massive AI data centers that are farming out compute power. So where does that land us? Again, I think I have to point back to looking at the post-IPO execution. If right now it might be difficult to say. And I think a lot of the early trading is going to be kind of built on that hype and FOMO. But what investors really should be looking at is the story after the public offering.
Avery, and I want to talk about one thing that's unique, I guess, with this IPO is Elon Musk came out and said he does want to have retail allocation. Now, SpaceX is only floating about 3% of its shares to the public. So the reality still seems that most retail investors aren't getting in at that $135 price. But here's what I wanted to ask you. The NASDAQ has rewritten the rule book with fast entry rules, potentially putting SpaceX into the index within 15 days of anyone holding, let's say, a triple Q ETF or anything that tracks the NASDAQ in its own. So is that actually sort of a backdoor opportunity for retail, or is that more of a backdoor risk?
For investors looking to get in that aren't going to get allocations, because yeah, as you mentioned, a lot of them aren't. This could be a backdoor into into SpaceX if you're not able to if you aren't able to get an allocation, and perhaps you're not maybe interested in buying just SpaceX. You'd like a diversified option. But for everybody who already holds those funds and maybe invested on a very different methodology, that's definitely a risk.
Avery, so that's SpaceX, and that's the one we got in our sights because it's bearing down on us. But also Anthropic. We're also looking at OpenAI later this year. These are huge. These are really big IPOs. The market hasn't quite seen something of this like. Can it absorb this many multiple IPOs at the same time in the same year?
Yeah, I think what we really have to look to is private markets first. Private markets have been very generous, and we have to remember that beyond these really big three names that we've been talking about, there are several other companies with $100+ billion private valuations that have raised hundreds of billions of dollars. And public markets are significantly wider, significantly deeper than private markets. So if those are able to absorb these really big names, then realistically, public markets will be able to as well.
Avery, now, what so far has unfurled this year is that AI has been this incredible engine that seems to obviously cannibalize or even compress some valuations while simultaneously even creating trillion-dollar IPO candidates. So how should investors sort of reconcile that contradiction that we're seeing when you have AI names that are coming out, getting these valuations, and ones that aren't?
Yeah, I think that really points to where in the AI cycle a company is. The companies that have been attaining these really large valuations, have been maybe doing well, are the companies kind of at the infrastructure level. Right now, there's a lot of demand for the build out that is going to kind of underlie these AI ideas. The companies that are just using AI, maybe there's moderate integration. Those are the ones that are getting cannibalized. There are AI tools specifically coming out that can do the things that maybe these software companies with AI, like AI, integrations, can do what they're doing without that underlying platform.
Avery, I want to get back to that idea of the NASDAQ, the index providers, bending, shifting, changing the rules for these major IPOs to enter the indexes more quickly. We were talking about the fact that, okay, it could be a backdoor for some investors. At the same time, though, some people are looking at this going, what's going on? The rules are in place for a reason. Are we simply modernizing the rule book to reflect a new reality? Are there risks being created by those changes that investors should be aware of?
Yeah, to your first point, I think that there is a desire for market completeness that needs to be balanced here. $1 trillion market cap is certainly not a drop in the bucket. So these broad market indexes that are using this argument as a reason for changing the rules to accommodate, because the market looks different than it did maybe even 5-10 years ago. But there are risks that absolutely need to be acknowledged, especially by passive investors who hold these funds. If you invest in a fund under a very different methodology, and now you're essentially you're investing in a fund that has maybe gotten rid of the protective attributes that you chose, maybe like a 12-month seasoning period or a liquidity screen that was implemented to reduce exposure to volatile early trading. This could really be an issue and could, be a risk that you were not willing to take on.
Avery, I want to take us back to part of the capital markets going back to 2021. I'm going to cast your mind there. This is the SPAC era. It's kind of the Wild West during that time. A lot of promises, a lot of pain. And now most recently, SPAC issuance climbed to a 4-year high in January with about 25 blank check deals raising about $5.2 billion. And that momentum has carried through to the spring. After that initial SPAC implosion of 2021 and 2022, what's different this time around? And should retail investors still trust that structure more now, or is it just deja vu all over again?
Yeah, I wanted to just give a stat here that we've had over 100 blank check IPOs year to date, nearly $18 billion raised. So this is on track to be the biggest year since 2021 if the pace keeps up. And I think it's worth pointing out that, SPACs are still the primary choice for many early stage companies in very nascent markets. So the need for SPACs as a door to public markets hasn't disappeared. And I think maybe you could say it's ramping up with how many more disruptive pockets that are emerging in the technology space. But broader renewed interest and growth is definitely an appropriate backdrop for this pickup. And as for investors, are these the best the best options? It really comes down to a case by case basis. I will note that the blank checks we've seen being formed this year, we're seeing more experienced sponsors returning. So that is a good sign for management teams that have previously led SPACs through a merger. That definitely kind of maybe mitigates that execution risk.
So Avery, we know in the coming days it's all going to be SpaceX. Every time we open our browsers, look at our phones for some financial news, and Anthropic and OpenAI, they'll suck all the oxygen out of the room. Beyond those names, in terms of IPOs in the markets right now, anything else investors should be watching?
Yeah, investors should always stay on top of the IPO calendar themselves. I would say that the media tends to focus on the biggest names, the loudest names. But there are plenty of companies going public that many have never even heard of. I think we say something like 90% of IPOs are complete unknowns to the general retail investment space. So things that are worth pointing out. Maybe something like Databricks, that's a big name in enterprise AI, and if you follow the space, then you know what that does, but may not be as well known to the general retail population. And like I had mentioned earlier, it's a very large name. But beyond that, there are things like SB Energy, which is SoftBank's power infrastructure provider. So that's another play on the data center AI infrastructure space, which has gained momentum this year. And even something like the missile systems carve out of L3 Harris is that's reportedly gearing up for a listing. Defense has been a very hot space as well. So if you're not watching that space, if you're not familiar with that space, you might miss that.
Some interesting ideas for our audience to do their homework on. Avery, great having you with us. I hope we get to chat again soon.
Yeah, absolutely. Thanks so much for having me.
That was Avery Marquez, Director of Investment Strategies at Renaissance Capital. And just a reminder to our viewers that the securities and the strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Hearing another great conversation on the show, of course, SpaceX being the big one. There's so much good stuff in there. I like the idea that, okay, we know the first day is going to be pretty choppy. It's going to be pretty wild when the action finally starts hitting the tape. It starts trading publicly. Avery's saying, hype and FOMO, but watch the aftermarket. Even on day one, watch the aftermarket to see how this, appetite could play out beyond day one.
Yeah, absolutely, Greg. I know she mentioned it. If certainly private markets have the firepower to absorb it, then the public market certainly will once it does hit the tape. So when it does go to debut, and I think that's an important reminder as well for a lot of retail investors. While as much as we'd like to potentially get into the IPO price, that may not be a reality. It is going to get onto the the listing as soon as it goes up. It's a free fest for everyone to kind of get their finger in the pie if they wanted to do that. But obviously, she pointed out some valuation concerns. Notably, I think there's a lot of drums ringing that, beating that beat, of course. But it's important to realize, as you mentioned, Greg, right? It's a call option on Mars at the end of the day. There's a mishmash of what we're doing here, and that seems to where the goal is going. Out of the companies that really are kind of driving or make up SpaceX, there's really just Starlink at the moment that's kind of pulling its weight in terms of actually bringing positive revenue, where the others are still ramping up there. So we'll see, obviously, in that 20 to 30 year window what shakes out, but that's a long road ahead, of course.
And for our purposes, I think our best shot of capturing the first trade would be Money Talk Live on Friday, June 12th, if that's the date that we're thinking. But you're always just waiting. You're waiting for that first trade, and hopefully we'll get it while we're on live on air talking to our audience. If you at home have a question for our guest or team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. Just open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. It's time now for Technical Take, and the stock in the spotlight is IonQ, a leading name in quantum computing. The race to build machines that use quantum mechanics to solve problems blazingly fast is igniting investor interest, particularly after Washington committed $2 billion in grants for the industry. While IonQ has seen strong revenue growth, it's also spending heavily on research and development, and that is driving large losses. Also, no shortage of competition out there. The company is looking to grow this nascent technology. There's a lot going on here. Hiren, let's go to you for your take on IonQ.
Yeah, absolutely, Greg. As you said, IonQ is one of the purest play quantum computing companies out there on the public markets. It differentiates itself because it builds and operates trapped ion quantum computers. It's a fundamentally different architecture than superconducting approach that's used by IBM and Google. So One of the things that this company is, it's not making money yet. It's operating on an EBITDA loss. Management had guided for about 310 to 330 million this year. A lot of that is going into that R&D spend. So the story is very much build now and profit later about it. But they did have some notable coming out of Q1, some notable milestone they achieved. The first was that they're the world's first commercial. They did the world's first commercial demonstration of two connected commercial quantum computers, paving the way for distributed quantum computing networks. And second, they just got announced that their 1.8 billion acquisition of U.S. semiconductor foundry Skywater Technology, that really creates the world's first vertically integrated quantum computing company here. So really, what we want to see is we want to see the charts like we had Q1, Q2 is going to come up in the next couple of months. But let's turn to the charts, Greg, and see how the price has been shaking out. I'm just going to first just zoom out just for a second. We've got the daily charts that we're looking at over here, and I wanted to point out to our viewers first that we've got this one primary weekly bullish trend that's formed. You can see we formed it on the lows. Every time it's kind of reached these sort of lows, it's bounced off of it. So this overall, the stock is still in a bullish macro price structure that we have over here. We did see quite a significant run up into the fall of last year, into September, hitting all-time highs at 82.09. And then it did do that corrective action, the medium-term bearish trend that had formed, where it was rejecting above this trend. Here's where we kind of find ourselves in just coming into April now. We once it hit that around that 33 mid-February, it's made a 71% room move up to the upside after having this sort of reset down here in the $25 level. And here's where we currently stand. So we did form quite some bullish signals in the interim. So there's a bull flag pattern that had formed, which pushed the next leg up higher. So in the shorter term, we do have the support level sitting at 55 right now. That's a near key level that I'm looking at. It used to be a previous area of rejection. Now we want to see if it's going to retest and become a support there, validated. On the top end, we are looking at resistance sitting at 75. It's an area which it was previously rejected, barring how it had broken up here. But it was an area that it needs to really have a strong catalyst to break free of and start a new leg higher into price discovery zone. So these are the sort of key levels I'm looking at. One thing I just wanted to note, this candle here, Greg, this was on May 8th. This was the announcement where Skywater Technologies board shareholders approved the merger deal, and you saw a 15% pop on the stock, and this is what really started that new leg up. We did see a bit of a pullback, but then it started that new wave higher. So this is what we're looking at coming into IonQ and maybe in the next couple of months as it heads into its Q2 earnings there.
That is a very interesting chart. Now you're going to walk us through a couple of ways we could trade IonQ. Before you get started on that, just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Where are you starting with us, bull or bear?
Let's go with the bull, Greg. So we'll switch out the bull trade over here, and I'll just bring to our viewers what potential trade could be. So based on what we had mapped out with the technicals, one of the strategies you could consider is a short uncovered put option. Essentially, it's a single leg trade. That's all we're doing. We're going out into the option chain. We mapped out that key support at 55, but we're going to just give ourselves a bit more room over here and look to sell the $50 strike put. We are going to give a lot more time just so we can juice that premium a bit more with the time value that we have over here. So this is what we're going to be looking at in terms of the trade. It is going to net us about $5. That's what we're looking to get. So that means our break-even price is at 45. Now, it's important to just understand sort of the backdrop as well. We do see a bit of a pullback coming into this stock. It is sitting sort of in the upper quartile of its implied volatility profile there. And the expected move going out there is about $26. So this kind of puts us right in that just outside of the zone if it did have a downside move there, Greg.
All right, you've always got a reveal for us. What are we putting into play here? What are we putting into play?
So it's important with this strategy, because it's an uncovered put, there is going to be some risk that we have to consider. But before we do that, obviously the best case scenario is going to be whenever you're doing a short strategy when it comes to options, ideal outcome is we want the option to expire worthless, and that's only going to happen as long as IonQ stays above $50. if we're holding this option till expiry there. So that's the best case scenario. That's what our max gain is going to be. The worst case scenario is going to be, well, if it starts moving into the $50 zone and lower. So up until a break even, we'll start losing a bit, but if it goes below 45, that's when we start losing. We do have to position by the fact that the worst case scenario in theory is that IonQ goes to completely zero. In that case, we're going to be out completely $45. The reason is also that when you do a short uncovered put, it's a way of actually acquiring the stock because you have assignment risk. So if it goes in the money, you're going to be forced to potentially buy the stock, 100 shares of it, at the strike price you've chosen at $50 there. So this is what we stand to also lose and also have a risk with assignment as well there.
All right, show me how the other side can play it now.
All right, so let's switch it over to the bear side now here. So in the bear trade, what we're looking to do here essentially is we're going to speculate on a directional move down, especially because we've mapped out that 75 level as being an area of rejection where it's been resistance, it's met with resistance. And the recent candle price action has suggested that there is some more bearish sentiment building, potentially either testing the 21-day or potentially the 50-day moving average there. So the strategy we're looking to do is a long put condor. So what this is, it's made up of essentially 4 option legs. I'll break it up into each of its parts. So first we have a debit put spread. So here we're looking to buy the 75. We're going in the money over here. In fact, when we set up the trade, the stock was trading higher, and we're looking to sell the 65 strike put over here. This, at the time I had set this trade up, was roughly a net debit of $5, and it's important I want to keep it that. The second part of this is we want to sell a credit put spread further out where we mapped where we think there could be some demand coming in. So sell the 50 put and cap it off by buying the 45. So we're doing an uneven amount here. We're doing a 10 width on the debit and we're doing a $5 width on the credit spread. The reason I want to do that, Greg, is because I want to make sure that my loss profile does not change with what I've spent on it there. And I have the reveal here. So
I saw it peeking up.
I was peeking and teasing it out there. So let's talk about first what we want to happen is obviously it's directional, so we do want the stock to come down, but we want it to kind of come down to break below 65 and stay within 50 to 65. And if we can do that, we're going to make a max gain of $5. The simple way we calculate that is take the spread over here, 10, minus what we're putting into this trade, which is $5, and that ends up being $5. However, where we do stand to lose is, let's say we do go down to into this area where it crosses below 50 and breaks below the 45. This would be almost like a scratch trade. So yes, we made a $5 gain at this point if it goes all the way down, but we have a $5 loss as well that we have to contend with. So this way it's going to net even out there in the trade. And that's why I didn't go equidistance. I reduced my width on the short side, so that way we didn't increase our risk profile there on the trade.
And 2 very interesting possible trades. Thanks for that here. And that is our show for this week. As always, investors should perform their own due diligence before engaging in trading. They should also tune back in on Tuesday for another TD Active Trader Live. Herein, the debate itself is going to be on Darden restaurants, but of course, that is SpaceX week as well.
That's right, Greg. We are going to be doing a little fun segment during the show next week because, you know, with SpaceX's S1 release, there's a lot of numbers we can peer through. So myself and Brian, we're going to do a mini debate on SpaceX bull and bear case, looking at purely from the fundamental side of things. So definitely tune in for that. We've got some, quick 3 to 4 zingers there for you to really evaluate and see which side you land on that coin, whether you're bull or bear there.
It's going to be a good one as always. Don't miss it. Thanks for watching this one. We'll see you next week.